Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing SCWorx's stock by analyzing their financial ratios and dissecting their financial statements, so we can determine if they're a buy or a sell. SCWorx provides software solutions for healthcare management. The company also sells rapid test kits for COVID-19. Let's get started with the model. This is a micro-cap company. Market cap $22 million. They're trading at $2.22 a share, and they have 10 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. Their revenue doesn't look so hot. It's $4 million in 2017. It's less than $500,000 in 2018, $6 million in 2019, and $5 million in the trailing 12 months. This is the company's income statement. The top line is the revenue, then the cost of revenue. Below that is gross profit. They did have $1.2 million of gross profit in the trailing 12 months, but the operating expenses were really high, $11 million, so that gave them negative operating income. They have negative operating income every year. This is the statement of cash flows. Although in the trailing 12 months they had negative $11 million of net income, they only had negative $1.6 million of operating cash flow. And they have very little in capital expenditures. So obviously they have negative free cash flow every year. But it seems to be getting smaller as time goes on. Only negative $1.6 million of free cash flow in 2020. The reason operating cash flow is so much better than net income is because the way you calculate operating cash flow, it starts with net income, and then you have to add back the non-cash items. They paid $5.4 million in stock-based compensation. This is when you pay employees with stock. So it's not actual cash that goes out the door, it's stock within the company. That's why it has to be added back on operating cash flow. And also they had a positive $2 million in changes in working capital. These are changes in accounts receivables, accounts payable, and also they had a positive $1.9 million of other. Obviously the company can't survive from its operational cash flows, so it has to borrow either through debt or equity. And the company doesn't use much debt to finance their business. They mostly use equity, and that's $2 million in 2017, $7.4 million in 2018. Let's look at a capital structure. They have $1 million of debt, $7 million of equity, and their WACC is 11.76%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $28 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $16 million. We divide that by 10 million shares. And we get a calculated stock price of $1.63. They're trading at $2.22, so they're trading at a 36% premium. It's a sell according to the model. Simply, Wall Street doesn't have a valuation for this company because there's not many analysts that are looking at this stock. Although the company reports negative free cash flow each year, and the company is struggling getting revenue during COVID-19, I do think things will improve. They don't seem to be as bad as their financials appear. And if they do, I think their cash flows can grow. Of course, anything can happen. Nobody can predict the future. So this is the company's historical stock price. You can see they IPO'd in 2016. The company actually was founded in 2012. And it looks like the stock price was over $80. But the reason it looks that way is because they did a 1-for-9 reverse stock split. So you have to divide these numbers by 19 to get the true price. And if you invested $10,000 into this company when it IPO'd, you'd have a little under $300 today. Let's look at the financial ratios. The average PE is 14, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Average price of sales in the market is 6.0, the median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 4.4, so they're between the median and average. The average price to book is 4.6, the median is 2.4. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. they're at 3.2, so they're also between the median and average. Equity is assets minus liabilities in the balance sheet. Their tangible book value is negative 1.6 million. Book value is the same as equity. To calculate tangible book value, you take the tangible assets, which means you remove the intangibles like goodwill, patents, trademarks, things like that. So only the tangible assets minus the liabilities. Average interest coverage ratio is 12.1. The median is 3.8. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. EBIT is earnings before interest and taxes. Average ROE is 10%. The median is 11%. ROE is net income over equity. They have negative net income, so they have negative ROE. Average current ratio is 1.9. The median is 1.3. Current ratio is current assets over current liabilities, so they cannot cover their current liabilities with their current assets. Their current assets are $500,000 of cash, $800,000 of receivables. So they don't have enough current assets on their balance sheet to cover their free cash flow deficit if they have the same free cash flow next year as they have this year in the trailing 12 months. But the difference is only $700,000, so they can probably come up with that through debt or equity financing. And their working capital is negative 1.8 million. Working capital is current assets minus current liabilities. The best way to look at ratios to compare them to similar companies, I've done videos on CompuGroup and Teladoc, both in the same industry as SCWorx. And if SCWorx has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They are better in PE than the average because the average is negative 13, they're negative 2. They're better in price to sales and price to book. They have a really low current ratio. Terrible ROE. They have the lowest amount of debt of 3 companies, but they're a really small company, only 22 million market cap. So to summarize, I do have them trading at a 36% premium. So if they don't go bankrupt through COVID, they could turn it around and maybe make a profit. Their ratios are decent, but their financials are a bit weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.